So I found out Paul didn't realize that he made me the last speaker again. This is actually the second year. Okay. I'm actually benefiting in a different way, though, in the sense I think this is a really good paper. That's actually problematic in a certain sense. I'm not going to chew up too much of your time because I know it's late. But it's a really good paper. It's definitely worth reading. Everything he said is basically correct. I don't have any problem with any of it. That actually makes it hard in a way, being a discussant, of course. You don't want a really bad paper, but you don't want a really perfect paper either, because then you don't have much to say. I have a few things to say, actually. Some of them motivated by things that weren't really reflected in the talk. So basically what he does in the paper is the suggestion, the point is banks created these conduits basically because they could get away from capital charges on holding these assets. They could collect the payoff on the assets. What a deal, you know. And basically what they document is, yep, that's what they did. And these conduits had these full liquidity guarantees. They had the same runoffs basically and the same changes in credit spreads as ones with full credit guarantees because they made it a function of slow-moving variables and they were overnight securities anyway. So you can usually see default coming the day before anyway. So the uses of the various guarantees, one of the things that wasn't reflected actually, this is just a copy of the table from the paper, is that commercial banks weren't the only ones to use these actually. Structured finance, which I'm not quite sure what these are other than maybe just special purpose vehicles. Mortgage lenders, who I assume are using it to warehouse loans before they actually securitize and sell them off. Investment managers and then investment banks, and those are pretty small. And this basically shows the relative use of the different kinds of guarantees and liquidity guarantees. Clearly the most popular were the commercial banks, and that makes sense if they're trying to avoid the capital charges. So then there's another table that has even more detail in the paper. And when I saw this paper, I thought, I'd really like to see a couple of chi-square tests. It just begs for it, at least to me, when I look at a 3x3 and I say, are these things really that different, and it's particular in the ways I might expect? And it has the advantage of being fairly non-parametric, to making a lot of assumptions about error terms. I was a little puzzled about one thing, and the talk didn't really take the puzzle away, which is, if you look, the full liquidity, this is the quantity of asset-backed commercial paper. The full liquidity ones, the red line, that's pretty much a flat line. And then the full credit ones fall. But then in the regression, there's no statistically significant difference. It's like, there's a difference. And so one possibility is, see, in the regression, they're using daily data. So you have this gradual trend, and actually the data ends in November. And so that might be it. You might actually be better off if you just use means, even though some people might think it's just too trivial, is that it's really the mean difference that you're looking for anyway, and having daily data doesn't necessarily buy you very much in terms of doing that. And it might show up then. The spreads, they basically show the same thing, and that's actually more consistent. One of the things that he didn't do in the talk, so I can do it, is one of the things they look at is as well, okay, so suppose you had the capital charges on these conduits. Would they have been profitable? And the answer was no. So that's very consistent with the entire line of argument. That raised a question in my mind, actually, as I thought about it, which was there any profit available to these conduits that wouldn't have been available to the bank if it held the securities anyway? And it's not obvious there would have been anything. That's just something to think about in terms of valuing that alternative, that it's not obvious that they were creating economic value by creating these conduits. So there's some thoughts about this. This isn't really all of the story. There are a few sentences in the paper that kind of suggest maybe it's a very big part of the whole story. But for example, Wells Fargo had 0 assets in these conduits, and they still had a lot of trouble. Wachovia wasn't a big one, even though they acquired them, and they were problematic themselves. They talk about, I'm not going to chew up very much time with this, but I'm going to chew up a little bit. They talk about the modern day equivalent of a bank run. You know, and this is related to discussions about shadow banking, which he nicely puts in quotes, which I would too, actually. Because there's a question is, so what is the implication of all of this? Okay, for the commercial banks, I think the implication's obvious. This stuff should have been on their balance sheets in the first place. Right? I mean, that's just goes without saying. Although one thing I would have liked to have seen would have been some language from these contracts about what the liquidity guarantee really says, actually. It just occurred to me, and it's occurred to me several times. So the question is, what's the regulatory implication of all of this? Should any structured vehicle that issues overnight commercial paper be regulated as if it's a bank? And I think the answer to that is not obviously. Why do I think that? Why do I want to suggest that? It's something worth thinking about. It's because it's not the run or the decline in the value of the liabilities of the institution that in and of itself is the reason we regulate banks. The reason banks are regulated in the way they are is because they're involved in creating money, and that has adverse effects on the economy, substantial. Now, it may be that these institutions do too, but nobody's identified anything like that. And I think that's something that's definitely worth thinking about anytime you think about possible regulatory implications of all this. Like I say, it's an excellent paper, and it was fun to read.
Excuse me.
Oh, yes, I'm sorry. Here. I walked off with you.
So first of all, thanks a lot for the comments. These are excellent. A few things you have said we already thought about, but we haven't put in the paper yet, and there are 2 or 3 things which we haven't thought about yet, but I think I really want to put in the paper. So that's excellent. You mentioned you mentioned 2 things. I just briefly want to respond to that. I'm just going to pick 2 comments, and then I want to open it up for questions because I think we're short on time. One thing is, we really want to be clear that this is not all of the story in some sense of the financial crisis. We think a lot about the start of the financial crisis was about that, but this is clearly not everything. So that's why we also want to have some measure of the magnitudes, because I think a number of banks came out with losses on other investments they've made which might be larger than these. So we really want to sort of really think of this one example rather than an explanation of the crisis. The other thing which you mentioned is in the structured finance groups. I didn't get to talk much about it. There is a bit of a data problem because it tends to be that some of the investment bankers who work for commercial banks and had done a lot of this actually ended up setting up their own little groups, and then they buy the guarantees from elsewhere. And that's partly commercial banks and also partly investment banks. We know anecdotally that investment banks were not setting up these directly, but were doing it through these investment groups. But they had different capital requirements. So we can't really drill down on them because unfortunately we don't have the data. And about the graph where you were a little bit puzzled, I should have made that clearer. Here we're just adding up total asset-backed commercial paper outstanding. So we are not weighting by the size in the regressions. So the reason why the 2 diverge is because especially the larger conduits were able to issue, whereas the smaller ones were not able to issue. So in the regression, which doesn't weigh by size, they don't look different. But there's sort of variation in size, and that's why they look different in the graph. And they actually wanted to make that clear in the paper. That's why we put both of these things in. But anyway, thanks for these great comments. And if anybody has a comment or a question, yes, Ed.
Just from a statistical point of view,
Yeah.
there's some really interesting hypotheses in your tables 6 and 7 about the effects of these guarantees. That you're testing everything against the hypothesis of 0, and that you can do covariance analysis trying to show the extent to which the other kinds of guarantees didn't differ from each other, but did differ from the full credit guarantee. And on the interaction terms, I don't know, have you ever heard of the Lindley paradox?
No.
The Lindley paradox says that when you test with really huge samples like this, the nature of the testing changes. Your tests get more precise. And so it's recommended that you increase or decrease the significance levels that you take seriously. So I would say most of those interaction terms don't deserve to be taken as significant, statistically significant in the way we usually talk about it, because the samples are so large.
Mm-hmm.
It's always a trade-off in testing between type 1 and type 2 error.
Yeah, I mean, one thing which made us confident in some sense is the non-parametric tends to basically point towards the same direction as the parametric analysis. I mean, you mentioned table 6 and 7. It's also, we actually look also at triple interactions that you presented here. We wanted to see whether the effects are larger for banks which are more risky, because then you would think that the guarantees are not worth as much. But we are losing a lot of the sample because a lot of these banks don't have CDS spread. So we're actually trying to replace it by other proxies of the riskiness of these financial institutions. Also, these are measured contemporaneously, so you would think that maybe having these conduits might affect the CDS spread. So we're looking at ex-ante measures. So that's something we wanted to change. But yeah.
In terms of these it's only in the interactions that the limiting paradox arises. And again, it gets back to Jerry's point that taking the mean is saying, well, all this daily data really isn't that much of another real observation, given that the event was really one event.
Yeah. No, we tried to address it to the extent that we allow for correlation of the error terms. So we cluster at the conduit level. So I think that allows for thinking about one conduit as one observation in some sense. But I think you could argue that maybe we should cluster at the sponsor level. That's something we have thought about. And we also had a suggestion from Mitch Peterson, who said we should double cluster at the time and at the conduit dimension. So we're just looking into that. It just gets a little bit more difficult to code up. Jerry, you had a...
No, the point is, the limiting paradox is, suppose you have 1 million observations. How many variables do you think are going to be statistically insignificant? It's like 0 at a 5% level.
Yeah.
And you have so many observations, they're not really different. That's
Yeah. No, I think we are taking care of this with the clustering, but I should make sure that that's correct. Yes. Yes.
No risk transfer.
Yeah.
Yet there was a capital requirement.
Uh-huh.
So I was wondering what your thinking was as to why these existed in a non-significant number of cases.
Well, I mean, in some sense, over the entire sample, it's it was something like 12%. Now, if you break it down, and this is coming back to the table which you showed before, it's mostly the non-commercial banks. So like the structured finance group were doing a lot of that with these full credit guarantees. So also coming back to what I mentioned before is it seems a lot of that were coming from the investment banks, the broker-dealers, who were already using, at least in the US ones, were using the Basel type 2 capital requirements. Now as a Basel 2, when you use what's called the internal ratings approach, then actually this difference between full credit and full liquidity is not so big anymore. It really depends more on your modeling assumptions. So that's where we think this is coming from. It was very rare among the commercial banks.
Maybe one more question? Or 0?
0. Okay, well, thanks a lot.